This week on Escape the Clock, we are tackling a question most financial independence plans never ask. What if the tool you've been avoiding is the same one the wealthy use to pay almost nothing in taxes? Here's a number worth sitting with. According to a 2024 Morningstar analysis, tax drag alone reduces the average investor's net worth by 1 to 2% every single year. Over a 30-year career, that silent erosion can consume hundreds of thousands of dollars in wealth that was rightfully yours. And it gets harder from there. The gross national debt has crossed $39 trillion. The Congressional Budget Office projects deficits averaging 7.2% of GDP for the next 3 decades. Social Security's trust fund is projected to hit insolvency as early as 2032, potentially triggering an automatic 24% cut in benefits. Against that backdrop, the assumption that your tax rate will be lower in retirement than it is today is not a plan. It's a guess. I'm joined by Randolph Love III, a financial strategist with more designations after his name than in it, who has spent his career helping business owners and high net worth individuals find the exits in the tax code that most financial advisors walk right past. His argument is simple. The wealthy don't try to outrun the tax burden. They move their capital into environments where it doesn't exist. And the vehicle they use to do that, the one hiding in plain sight inside the IRS tax code, might be the very last thing you'd expect. Stay tuned to learn why the wealthy buy life insurance to live stronger, not to die richer. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. In the financial independence community, there are 2 things we generally hate: taxes and life insurance. We hate taxes because they are the single biggest drag on our wealth. We hate life insurance because it's usually sold at a high fee, usually enriching the agent more than the client. But what if I could tell you that the wealthy don't buy life insurance for the death benefit? They buy it for the tax benefit. You see, for a high income earner to match a 7% tax-free return, they would actually need to find a taxable investment paying 11 to 13% every single year just to break even after Uncle Sam takes his cut. That's a massive performance hurdle. You're essentially running a marathon wearing a 40-pound weight. The wealthy don't try to run faster. What they do is they try to take off the vest. They use the IRS tax code, specifically Section 7702, to move their capital from high drag environments to no drag environments. And the vehicle they use to do that is generally life insurance. My guest today is Randolph Love III. He is the founder of ShieldWolf Strongholds and the author of the forthcoming book, The Miracle Money Vehicle. He specializes in helping business owners and high net worth individuals structure their exit architecture so they can walk away from their jobs in less than a decade, not by earning more, but by keeping more. And he argues that we've been looking at this asset class all wrong. We look at it as death insurance, something that pays out when we die. But he looks at it as banking insurance, a place to store capital while we're still alive. Randolph, welcome to Escape the Clock.
Man, I appreciate the gracious introduction, and I'm going to borrow that. The wealthy don't try to run faster; they just try to take off the vest. And I'm okay with you calling me ShieldWolf Strongholds too. I'm okay with that as well. But I appreciate it, man. Thank you so much for having me on your show.
Both the wolf and the wealth.
Yes, sir. Yes, sir.
Well, Randolph, I want to just jump right in here because you are the expert on this and I'm excited to learn about it. So if this is such a powerful tool for the wealthy, why does almost every financial guru for the middle class call it a scam?
Well, first and foremost, let's just say the obvious thing. It really depends on your licenses and how you make money. All right. So depending on a person's licenses and what they've been taught, they're going to just quite naturally speak toward what they speak toward. But I would have to ask somebody just in life, if you're dealing with somebody who says, oh, yeah, what that person over there doing is just not for me, versus the person that says, not only is what that person doing not for me, but they're going to hell. Like, which person do you want to be around? Right. So it's really just how whatever philosophy that you choose to go with. Usually the reason why a lot of people say utilizing life insurance based off those internal revenue codes, you mentioned 7702, but there's also multiple internal revenue codes that back this up. But The reason why is a lot of times it's just a tool. And if you have the wrong person utilizing the tool, it can be dangerous. If I were to put a chainsaw in the hands of a skilled arborist, and even if it's a huge tree in between two houses, that arborist is going to get up that tree, cut those limbs, get that tree down, get that stump removed, and in no time at all, it's going to look like a tree was never there and no house was damaged. But if I were to put that chainsaw in the hands of a little baby, I mean, you got a lawsuit on your hands and a chopped up baby, right? So it's really the reason why a lot of people call it a scam is because they really don't know how to structure these things. One of the old sayings is, to a hammer, everything looks like a nail. But if you have somebody that knows what they're doing, is not as dangerous. So it requires more skill. And a lot of people don't have that.
Yeah. It's not just about getting sold on a policy. It's about structuring a policy based on a goal.
Mm-hmm.
And, the tax thing is a big piece here because there was this 2024 analysis by Morningstar that was just looking at tax drag and how it actually impacts people's returns. And they were showing that it will reduce an investor's net return by 1% to 2% every single year, which that compounds, right? And that can be a massive wealth gap in 30 years. So I'd like to get a little bit into the basics first and then go deeper with you, because a lot of people are told that deferring taxes in a 401k is the smartest thing you can do. But I was hoping you could get into the tax bracket myth a bit and why betting that, lowering your tax bracket when we retire is too late.
Mm-hmm. So it's one of those things to where if you actually just look at statistics, and so we're going to talk about statistics and then we're going to actually talk about what's actually happening to people. Most of us have access to somebody that's 70 to 80 years old. So you can listen to everything I say, or you can actually go and ask them what actually happened. They'll happily tell you. Some might begrudgingly tell you, but they'll happily tell you. So when you are pulling money from a asset or a retirement vehicle like a 401k, not only, are you restricted into 59 and a half without being able to access that without additional 10% penalty on side of whatever effective tax rate is. But even after that, if somebody were to tell me, hey, when you're retired, you're going to have a lower tax rate, I hear two things. So first and foremost, you have no faith in my ability to generate income as I get older. Like you just essentially told me that I'm just going to remain a pauper for the rest of my life. But let's say that's not what you're saying. Another thing they might be saying is most likely tax rates are going to go down in the future. Well, listen, if I were to put on a list, what do you think are going to happen to taxes? Are they going to go get lower, stay the same, or go higher? I think most people, based off of their experiences, might say that taxes are going higher. Now, depending on whether it's a Republican or Democrat administration, usually in a Republican administration, taxes are generally lower and taxes are generally higher in a Democrat administration. But hey, you have no idea what the political landscape is going to be in the future. You have no idea if you're going to be making more money in the future. But let's say all things remain the same. Typically, you're not going to be making as much income and therefore your your tax bracket is going to be lower. Yeah, you might be making less income, but typically when people retire, they're no longer paying toward their mortgage. There goes that tax credit. Typically, when people retire, they're no longer contributing toward a qualified retirement account. There goes that tax credit. So now your effective tax rate is the same, if not higher, than when you were actually working. And that's when you need the money the most. If you were to go to any farmer, all truths are parallel. That's the philosophy that I follow. If you were to go to any farmer and ask them would they rather pay taxes on what it costs them to buy a handful of seed versus what they would earn off selling a field full of crops, every farmer would tell you, I'd rather pay taxes on what it costs me to buy this handful of seed and keep all the money that I got from the crops tax free. The same is relatable when it comes to money. Why not go ahead and pay the tax on the seed now based off an actual tax rate that you know that's happening versus an unforeseen tax bracket in
the great debate over pre-tax versus after-tax for sure. And, your point about taxes in the future and folks that are super aware, right? Like when you come down to deciding your tax strategy about now versus the future. Do you want to pay the taxes now or do you want to pay it later? You're going to pay the taxes. There's no avoiding it.
Eventually, you're going to pay it.
Yeah, there's no third option. So the question is like, do you take the hit now or later? Well, usually the reason we take the hit later is because we can do a qualified deduction now. We can lower our income and hope that the tax situations would be better in the future. But with trillions of dollars of debt and just Social Security stretched to the way it is, it's hard to imagine inflation and taxes not getting worse for sure. So Randolph, you describe 401k as a partnership with the IRS instead of ownership. Maybe go a little bit further in the tax deferred versus tax advantage nature and why people should be really thinking about this differently.
Okay, yeah. So like I said, all truths are parallel. So let's say I wanted to go in business with Escape the Clock, right? But I wanted you to do all of the podcast episodes. I wanted you to pay for all of the equipment. I wanted you to go to all of the conferences. I want you to be the one chopping up these episodes, editing these episodes, shaking all of the babies, kissing all of the hands, right? I want you to do all that. And at the end of each year, I want 30% of your profit. No, as a matter of fact, no, I want 50% of your profit.
Dang, ruthless.
No, as a matter of fact, I want the option to change my cut at any time without no input from you. Would you take me on as a business partner? Escape the Clock.
No offense, but hell no.
That's what a qualified plan is. You are essentially saying, hey, I'm going to go out and work. I'm going to make the money. I'm going to do everything. I'm going to bring it all in. And then I'm going to give you a piece. And then I'm going to also give you the option of changing your mind at any time on how much I owe you. So really, it definitely is a partnership that most people, if you describe it in the way that I just described it, which is what it actually is, most people wouldn't go for.
Right. Yeah. I was doing some financial planning for somebody and they had all of their plan was in a 401k, all of it pre-tax. And so I had to start looking at required minimum distributions because at age 73, those are going to kick in. Have you ran into that a lot? And why help people understand that just doing what we're told to do, which is take that match, keep putting money in that 401k is eventually going to bite you?
Absolutely. Because, all right, so let's look at it like this, right? Let's look at it how a doctor treats a patient, right? Let's say by the time a person gets to the doctor and let's say the person is obese, right? And let's say the person has arthritis or gout or whatever, all those other injuries that typically come with age. What does the doctor tell them to do? All right, stop eating red meat, stop doing this. So the person starts doing what they should have been doing in the very beginning to avoid getting there. If you speak to people like myself and like you will realize that by the time people get to the age of actually to the distribution phase of their retirement plan, that's when they start talking about Roth conversion.
Exactly.
And for people who don't understand what a Roth conversion is, it's essentially saying, hey, your money has been growing in this tax deferred environment. And even though you may have built other resources of income in this other place, because of these required minimum distributions, because here's the thing, a thief is never going to rob you on the way to the bank. They're going to rob you when you're leaving the bank. And when you're retiring, that's essentially you leaving the bank. And that's when, hey, we're not going to just let this money just grow tax deferred and we're not going to taste it. No, if you're not pulling it, we're going to force you to pull it. We're going to make you stop eating meat. When your health gets bad, it's not that, I just like meat. When your retirement gets to the point to where it's untenable, it's not just, I just like deferring taxes. No, now you're going to have to actually spend this out. So let's say somebody just wants to put their money into a qualified account, at least get the match from your company. If you're working and you're contributing to a qualified retirement account, hey, I'm not going to tell you not to get that match. Go ahead, get that match.
Right.
But contribute to a Roth 401k, in my opinion, because now, once again, you're allowing the seed to be taxed in order for it to grow. And if it's a Roth from the very beginning, you're not going to be forced to do those required minimum distributions. And when you pull money out of it, it's not going to be considered taxable provisional income that's adversely affecting your Social Security, that's adversely affecting your Medicare. It's the equivalent of eating right from the very beginning.
Love that. Yeah. In general, I know the advice is take the match. That's free money. Then max out that Roth, even though it's after tax. And then if you still have room Go back in that 401k, put more in there.
Mm-hmm.
Absolutely. That's sage advice. Hope people hear that.
And I want to make sure to share one more thing. Since the Secure Act 2.0, now employers aren't required to do this, but I recommend that you can ask your employer, because what they're going to do automatically is they're going to put their match contribution into a traditional 401k. But since the Secure Act 2.0, they have the option of putting their contribution in a Roth as well.
So let's get into how to get this vest off. As of Q3 of 2024, U.S. banks held over $205 billion in bank-owned life insurance assets on their balance sheets. So the banks are doing this, right?
Mm-hmm.
And so why are they holding billions in life insurance? Let's maybe start there. Why is there such a massive disconnect between what banks are selling to the retail customers and what they're doing for themselves?
Okay, so I look at most families like business, and a lot of people like to try to disconnect a good family from a good business, right? A good business is doing what it takes to make sure that they are earning non-taxable income. A good business is doing what it takes to make sure that they're honoring their obligations, such as employee benefits. A good business is offsetting the risk of losing a key employee that sometimes become a unicorn. Because when you first hire somebody, typically you're hiring them, let's say it's just a receptionist. I just want you to answer my phone. But the longer they stay with you, now I want you to answer my phones and greet people at the door. Now I want you to answer my phone, greet people at the door, and go get my dry cleaning. And as an employee stays with you longer, they typically have more responsibilities and therefore become more valuable. If that employee were to die suddenly, you're not going to typically find somebody off the street to do exactly what that unicorn employee, that one that you built up over this time. Usually you're going to either have to pay somebody a lot more than what you were paying that employee, or you're going to hire 2 to 3 people to do what that one person was doing. The reason why these banks have so much bank-owned life insurance is because they're offsetting these risks and they're treating it as an asset on their balance sheet that's growing tax-free. And it using that ratio, they're able to have a better ratio when it comes to equity that's building in their company.
Gotcha. So it's serving multiple functions, it sounds like.
Absolutely. Just like it should serve for families. But most families try to get the most life insurance possible for the least amount of premium, when it really should be the other way around when you're working with a skilled person that knows how to structure.
I mean, the primary criticism of permanent life insurance is the cost.
Mm-hmm.
The industry standard shows that the average commission for a whole life agent is usually 80% to 100% of the first year's premium.
Mm-hmm.
That's a lot of drag on the early cash value. So with that criticism in mind, industry standards show that the average commission is 80 to 100%. And some will go as far as calling the whole life insurance a scam because of these fees. So can you explain the difference between a standard policy, which some people maybe is designed for that commission, versus a max funded policy, which is designed for the client's cash accumulation?
Mm-hmm. So I have a lot of industry designations. I'm a chartered financial consultant. I'm a chartered life writer. I'm a fellow Life Management Institute. I'm a chartered property casualty writer. I'm a retirement income certified professional.
Like Pokemon.
Oh, yeah. I got to get them all, right? And a lot of people say I have more letters after my name than in my name, right? But really and truly, it's because this is just something that I understand and I get. And I just wanted to make sure that I was able to take in everything that I could when it came on this subject. Now, there is a time and a place for whole life insurance. And the reason why I was able to get all these designations is because usually in the name, it tells you what it does. Term insurance is only for a term.
Right.
Whole life insurance, typically you're paying on the insurance for your whole life. Universal life insurance, specifically index universal life insurance, think of the universe. The possibilities are limitless. So there's a time and place for whole life insurance. Like for example, there's an Internal Revenue Code 412E that if somebody was willing to allow their money to be illiquid for at least 10 years, you can contribute utilizing this Internal Revenue Code. And based off that Internal Revenue Code, it either has to be a guaranteed whole life product or an annuity. And then after that time frame, now you have guaranteed income for the rest of your life. Now, in my opinion, that's the primary place for whole life products. But for me, typically it's better if you want to get the best cash value with eventually the lowest fees, then index universal life, in my opinion, is best when structured correctly. Now, these products are the most expensive the first 5 years. They are the most expensive the first 5 years. However,
when you're youngest too, right?
yeah. Oh, yeah. Yeah. Absolutely. Well, now we can get deep into the weeds. Now, because really, when you're structuring these things right, every permanent policy has a built-in term policy, right? Every permanent policy has a built-in term policy. So what happens is that cost of insurance technically gets more expensive as a person gets older. But when you are structuring it the right way, that cost of insurance is getting more expensive, but the amount of insurance that you're required to have per TEFRA DEFRA corridor gets lower. So it's essentially like a candle burning on both ends. So yes, most whole life products are very expensive, not just due to the loading, right? And that's usually that's another word for the commissions that agents get on the front end of the policy. Like I said, policies are the most expensive in the first 5 years, but it's because whole life doesn't allow you to switch the death benefit from what's called increasing to level. Index universal life allows you to switch it from increasing to level. Whole life policies stay at increase. So if you're able to not only reduce the amount of death benefit that you have, and you're able to switch the death benefit from increasing to level. And for the layperson, increasing means that when you die, you get whatever that face death benefit is plus the cash value, whereas level means you just get the death benefit. But if structured correctly, your cash value usually ends up being higher than what the initial face value was when you got the policy started. So when done correctly, the cost of insurance plus administrative costs shouldn't exceed an average of 1% per year. And the rest should go towards your tax-free cash value. I'm sorry, tax deferred, because we can talk about what it takes for you to access it for it to be tax free. But technically, the money growing inside is still considered tax.
I mean, there's a bunch of stuff in this, right? There's liquidity. How much access do I need to my money? The investability. Does this money grow? How static is it?
Mm-hmm.
How customizable is the policy?
Mm-hmm.
What is the tax benefits of the policy? How much coverage do I get from the policy?
Mm-hmm.
There's a bunch here. So it sounds like what I was hearing you go through here is like on the index policy, it is more customizable,
yes,
where maybe a whole life policy is going to be more static. And people are dynamic. Our needs are going to change, and cost and our income level will change, and all kinds of stuff, right? So it sounds like what you're saying is, at least in general, the index insurance gives people, meets them closer to what their needs might be in general. Is that right?
Absolutely. Just look at the name. If you ever want to know what a financial or insurance product does, just say the name of it slowly. Whole life or index universal life. And if anybody is a fan of quantum physics, when it comes to the universe, anything is possible. And yes, whole life policies aren't as transparent, and they are very static. Once you set it up, what you're doing, that's what you have to do for the most part. Now, you can match fund a whole life policy, just like you can match fund an index universal life policy. But remember, the primary goal of a whole life policy is always going to be the death benefit, and you will never be able to switch. And if that's your goal, that's one of the first conversations we got to have. What's your goal? If that's your goal for the primary to be the death benefit, then maybe whole life it is. But if your primary goal is for that money to grow tax deferred to where it gives you the opportunity to utilize it during your life tax free, then maybe it isn't the best product for you.
That makes sense. It sounds like you have to tailor the policy to your goals, and therefore you're going to need someone to help you do that, right?
Absolutely.
It's complicated. So in the case where, let's say I wanted it to help me in retirement,
mm-hmm.
What is a tax-free loan versus a taxable income? Like, how would you start helping me?
Got it. So there are 3 ways, and I first learned this from my mentor, Doug Andrew. There are 3 ways to get money out of a life insurance policy: the sad way, the dumb way, and the smart way. The sad way is you put down $100, you get $1 million policy started, and then the very next day you get hit by a bus. That's a great return on your investment, but a sad way to do it. The dumb way is to withdraw money, surrender it. The reason why is because that's a taxable event. When you outright withdraw the money and or surrender it, that's a taxable event and it's going to be considered income that you're going to have to pay taxes on. A little LIFO type. Well, actually, life insurance is treated as FIFO for the most part when done correctly, but
first in, first out.
So when you, oh yeah, there you go. Whenever I say something that's familiar to us, but I don't explain it to, I appreciate that. Whereas LIFO is last in, first out. But when you withdraw it, now you're going to get return of that basis plus that additional money that grown. You're going to have to pay taxes on that. Whereas the smart way to get it out is to borrow it. In my opinion, even if you no longer want this cash value life policy, let's say you just no longer want it, it no longer suits your need. I would rather you borrow out everything and let that thing just collapse and implode and lapse than surrender it. Because not only is what you're able to borrow typically more than what you're able to surrender it for, now you have this money in your hands tax free. So that's the difference between withdrawing it in a taxable event or borrowing against it in a tax-free event. But it's just most consumers have a negative connotation and association when it comes to borrowing. But when done correctly, it's a good thing.
Yeah, we actually just had an episode where we talked about borrowing with leverage versus consumer debt and how powerful that could be in your plan. You know, and the goal here is to attain financial freedom. That's what people are tuning in. That's what I did. And it's very teachable because work can be optional, but many stay at work because they're terrified of retiring right before like a recession or some black swan event or whatever. So how does owning a boring insurance asset allow things like my exciting stock portfolio? Like how would you compare those versus feeling comfortable to survive something like a market crash?
Oh yeah. What you're referring to is commonly referred to as sequence of return, right? Depending on whether the market is up or the market is down. If you're following traditional advice of pulling, 4 to 5% or whatever out, 4 to 5% of a larger amount is a larger number versus 4 to 5% of a smaller amount. Of course, I'm a chartered life underwriter, so I know a lot about all life products, but I'm an expert when it comes to IULs, Index Universal Life Policy. And when you're dealing with that, so just to make it simple, let's say somebody has $100,000 put directly into the market and $100,000 in a properly structured life policy, right? And let's say the market crashes 50%. So 50% of 100,000 is $50,000. Hey, pretty cut and dry. So if your money was directly in a volatile situation like that, you just lost $50,000 and now you're at 50,000. Index universal life policies, in that same event, you're not going to earn nothing that year, but you're not going to lose anything due to market volatility. And the reason why I classify that with not lose anything due to market volatility is because you still have a cost of insurance involved. You still have administrative costs involved. But if things were structured correctly, that's not going to be a big hit. But due to market volatility, you're not going to lose anything. So all things being equal, now you still have $100,000 in your life policy because they have what's called a lock and reset of your principal. But the person with the money directly in the market is at 50. Now, let's say the very next year, the market returns 50%, right? So most people would say, okay, I just broke even. No, 50% of 100,000 was $50,000.
Right. Yeah.
But 50% of 50,000 is 25,000. So really you're at 75,000. You haven't even broken even yet. And let's say you are somebody that had your money inside of an index universal life policy. And let's say you had you had it in a capped index, and we can speak about caps if you want. But so if it's a capped index, you're not going to experience that same 50% return. However, you didn't lose anything due to market volatility when that event happened. So let's say you have a 11% capped index and the cost of insurance and administrative costs is approximately 1%. You just got a 10% return on your money. Even though it was a capped index, you just got a 10% return. And now that person it has 75,000 and you have 110,000. Now it seems boring. Just like when, I don't know if anybody knows anybody that likes to go to the casino. You're never going to hear about when they lost money.
Right.
You're only going to hear about when they won money. So your friend is going to come to you that very next year and say, I just got 50% in the market. But you know that whatever you lose, you have to do at least double to break even when it's directly in there. Whereas if your money was in that boring insurance policy, yeah, you're at 110,000. You're not able to say that you got 50% return like that other person, but because you had lock-in reset inside of a life policy that's growing tax-free, now you just got 10,000 minus the cost of insurance and fees. You're looking pretty good. And if you keep doing that year over year, it only gets better and better.
Can you imagine if you could go gamble at a casino with an insurance policy?
Ooh.
And never worry about losing anything?
Oh, that'll be amazing. Hey, I'm sorry, Mr. Love. You lost all your money, but we're not going to take any more. We want to make sure you can pay that mortgage. Oh, nah, they don't. Hey, they might give you the phone number to the crisis hotline, but they're not going to stop you from gambling.
Yeah, it sounds like a lot of people think of this as like a liability on the balance sheet, but when you do it right, it's really more of a contingency, which can then act like an asset.
Absolutely.
Which is pretty powerful. Yeah. Well, this is awesome, Randolph. I really appreciate you coming here and helping teach us about this. I'd love for you to describe how people can connect with you and get help on this if they need it, and maybe what a first step they might take if they're looking to, start to structure a plan.
Okay, so what I want to share to people, there are two words that I think a lot of people know: idiot and imbecile. And if you were to look up the definitions of idiot and imbecile in a dictionary, it'll simply say a stupid person for both words. But if you were to go back about 50 years, it would tell you that an idiot is somebody with the mental capacity of 0 to 3 years old. An imbecile is somebody with the mental capacity of 3 to 7 years old. And if you were to go back to the very beginning, it'll tell you an idiot is a private. Now, what they meant by private person was the opposite of a public citizen, somebody in the government, somebody in the Senate, right? It just evolved. And the opposite of a public citizen is a private person. And it just evolved into the average citizen is a stupid person, right? And if you were to look up the original definition of the word imbecile, it'll tell you it's a person without a supporting staff. Now, they're talking about a stick. Now, a stick, it can help you walk. It can help you reach for things. It can help you defend yourself, just like a human staff can help you walk. It can help you reach for things. It can help you defend yourself. Listen, I'm going to tell people the first step is to hire a professional like my man here, like me, because you can't be a private person without keeping everything to yourself, without having a supporting staff, because according to the original definition of the word, you're an idiot, you're an imbecile. So once you realize and conclude that, yes, I do need supporting staff, you have to realize that not all supporting staff are created equal. So I would say this: if you are a business owner that wants you and your employees to retire higher than you would have prior, or your tax is at the max and you so stressed you can't relax, just reach out to ShieldWolfStrong.com or call or text me at +1 904 822 4262 and ask for Randolph Love III.
Awesome. And that'll be in the show notes as well. Well, thank you, Randolph, for coming on Escape the Clock. It's been really a pleasure speaking with you.
And man, thank you so much for the opportunity, man. It's 2 times, man. One more time, it'll become a trend that I enjoy our conversation.
I was on your show as well, so I guess we'll have to link to that as well.
Yes.
Awesome.
Entrepreneurs.com. It definitely, if you want to hear our first conversation when we were just associates, listen to that, because you got a little taste of us being colleagues, and maybe the third time we'll be able to call each other friends.
Yeah, right on. I love it. All right. Thanks again, Randall. My conversation with Randall Love III started from a premise most of us in the financial independence community have probably laughed off at some point: that life insurance could actually be a serious wealth building tool. I'll admit, I came into this conversation skeptical. I imagine a lot of you did as well. But Randolph made a point early on that I haven't been able to shake. He said that life insurance is just a tool, and if you have the wrong person explaining what that tool is and how to use it, it becomes dangerous. He didn't try to defend bad projects. He made an honest observation about an industry that has failed most of the people it claims to serve. The version of life insurance most people encounter is designed around the agent's commission, not the client's outcome. When the commission on a whole life policy runs between 80 and 100% of the first year's premium, the incentive structure becomes obvious fast. But that's a problem with how it's sold, not necessarily about what it is. And look, I'm not saying everyone needs to run out and pay for whole life insurance, not at all. As Randolph pointed out, there's lots of ways to structure policies toward your goals. And if you're like me, you want every tool possible to get the job done. And I'll be transparent here. I took a course on how to use these tools to optimize high net worth individuals' portfolios. And that's what turned me on to this strategy. It's one I missed in my own journey to financial independence. And if you're like me, you want every tool available. The wealthy have long used permanent life insurance not as death insurance, but just as a tax-advantaged storage vehicle for capital, a place where money can grow and can be accessed without creating a taxable event. IRS Section 7702 exists precisely to govern how much tax advantage these policies can carry. The banks understand this. According to the FDIC, U.S. banks held over $205 billion in bank-owned life insurance assets on their balance sheets as of 2024. They aren't buying it to protect anyone's family. They're buying it because it grows tax-free. It offsets liabilities, and it keeps working while it sits there. Then Randolph made a simple argument that gets debated constantly. Do you take that tax hit now, or do you take it later? He used this farmer analogy. Would you rather pay taxes on the seeds or on the harvest? The answer is pretty obvious. Wouldn't you rather pay on the small amount now and then profit from all the hard work that you did later on all of that growth? That's entirely the case for Roth accounts, and it's the same logic underpinning properly structured index universal life policy. Pay on the way in, not on the way out. The reason this matters right now is the fiscal reality that we're living in. The gross national debt crossed $39 trillion, and the Congressional Budget Office projects deficits averaging 7.2% of GDP every year for the next 3 decades, with debt to GDP potentially reaching 175% by 2056. Social Security's retirement trust fund is projected to reach insolvency as early as 2032, triggering an automatic 24% cut in benefits for everyone collecting at that point. Randolph put it simply, you can calculate for the tax rate you know, but you cannot calculate for the tax rate you don't know. And given everything stacked against the federal balance sheet, the idea that tax rates will be lower when you retire than they are today, that requires a serious leap of faith. That's the trap hiding inside a fully loaded pre-tax 401k. You do all the work, you deferred the taxes, and when you finally go to collect, the IRS is there waiting. Not at the door while you make the deposit, but on your way out when you have the full harvest in hand. Look, the 401k isn't the enemy. Taking the employer match is still one of the best guaranteed returns available to anyone. But maxing it out beyond the match, putting every dollar into a tax-deferred vehicle and assuming future tax rates will be friendly, that's the part worth reconsidering. If there's one action item from this episode, it's this. Ask your employer about switching to a Roth 401k. The Secure Act 2.0 gave us the door. You just have to open it. Now, a word on the IUL specifically. Randolph clearly advocates for index universal life policies, and I kind of understand why. Whole life gets sold to people who rarely benefit from it. A whole life policy can run 10 to 15 times more expensive than a term policy for the same death benefit. The structure is fixed from day one. It locks you into a premium, and then the agent pockets 80 to 100% of that in the first year. And when the death finally occurs and the policy pays out, many families are blindsided to discover that in a standard whole life policy, the cash value that they spent years building stays with the insurance company. Only the death benefit transfers. Some policies can be structured to include a cash value in the payout, but that typically costs more. And most people were never even told that option existed, let alone offered it. So when does a whole life insurance policy actually make sense? The answer is actually really narrow. Ultra high net worth individuals with federal estate tax exposure who need an irrevocable life insurance trust to cover the bill. Business owners with specific key man needs. Families with special need dependents. And in some cases, people who know they won't be insurable later due to health and need guaranteed permanent coverage now. These are the real use cases. They're just not most people's use case. For the rest of us, term life, IULs, and other structures are worth understanding. Because when built correctly, they can weather market conditions, provide an asset you can borrow against tax-free, and give genuine peace of mind. The lock and reset mechanic in an IUL means that when the market drops, the policy holds its value. And when the market recovers, it participates in the upside up to a cap. That's a very different relationship with your capital than most of us have been taught to expect. And look, I'm not saying everyone needs a permanent life insurance policy in their financial independence plan, but dismissing this asset class entirely because of how it's often sold or because of who sold it to you might be costing you more than you realize. I'd love to hear from you. Have you ever looked at permanent life insurance as a financial tool rather than a death benefit? What held you back? Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening and best of luck rethinking the tools in your financial toolkit, escaping the clock. I'll catch you next week. That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. The book, the free planner, and the one-on-one time with me are all waiting for you at escapetheclock.com. If this episode was valuable, please leave a rating, share it with someone who needs to hear it. I'll catch you next week.